The one challenge in this space as an investor is that you never know what's coming up, and you also don't want to just go into a deal because it's there. You want to go into it because it's the right fit. So I'd rather have money sitting in cash than just making it go back into work just for the sake of making it work.
We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cashflow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cashflow Pro, your real estate investing podcast and YouTube channel. I want to welcome you here today, and I'm going to be real honest. This is an episode that I've been looking forward to for quite some time. We've got with us Jeremy Roll of Roll Investment Group. I'm sorry, I had to look down because I wanted to make sure I got that right, Jeremy. Jeremy has been in this business quite some time. He's a mentor to a guy that is a mentor to me. So I just thought it was very valuable to have him on our show so that he could maybe spread some nuggets or share some just general knowledge about the real estate syndication business. Jeremy and I were talking a little bit before the show, and I don't know, Jeremy, we are a fund of funds, which I know, and I'm going to go ahead. My mentor is Hunter Thompson, and I know that you and Hunter are pretty close. And so the fund of funds stuff, just so you have some context to when I refer and use some terms like that, that's kind of what we're talking about. And so, Jeremy, how are you today?
Doing good. How are you doing? It's the usual sunny day in LA over here.
Man, that's great. I'll tell you, it's been a little bit rainy here. I'm about an hour from Nashville, Tennessee. And so we're just trying to get out of the cold early spring and get into hurry up and come on summertime. So
I'm originally from Montreal, Canada. I very much can relate to that.
Yeah, I guarantee you. Montreal, it's a nice place though. So anyway, so why don't you, generally what we like to start with here, or what I like to start with is to hear just a little backstory about maybe, because my listeners are probably early on, maybe in the real estate education, like learning how to invest or learning where to invest or learning even what to invest in. Now, we've had everything from people who talk about moving or investing with self-directed IRAs all the way to again, like I told you, down in the weeds and try not to get so technical, but we've had those people on as well. So, but we want to hear a little bit about your backstory, about how you kind of got maybe even interested in real estate.
Sure. Yeah. And thanks again for having me on. Hopefully this is helpful for your listeners. And then one important thing before we start, I'm not a financial advisor or investment advisor or an accountant or attorney or anything. So anything I'm sharing for everybody today, just my perspective as an investor. So
certainly. Thank you.
So I started investing in what I call passive cash flow opportunities. And I started with real estate back in 2002. So it's been 20 years now. And the reason why I got interested in that, to answer your question, is because I watched the dot-com crash happen, which some of you probably aren't familiar with, but it was a huge crash, mostly in tech stocks. And after that, I said to myself, I'm a very low risk, kind of slow and steady guy. Watching the stock market go up and down 30% in a year was not the right fit for me. I didn't think it was the right fit for my long-term retirement strategy, honestly, in terms of having the lack of predictability of what was happening. And so I started to look for different ways to invest, came across the concept of more predictable cash flow being probably the better fit for me. And I started with real estate down that path. So it was really more about a search for predictability for me and a kind of a shift away from the volatile stock market.
Sure, and I'll be honest with you. I'm a little bit of a young, and I was graduating high school when the dot-com bubble stuff went down. We were, but I just remember the sheer just the fear that just seemed like it just kind of captured everybody all at one time, because during the dot-com boom, there was never going to be another bad day, right? I mean, everybody was just moving in towards, like, they were just, this was the new gold rush, and again, there was never going to be another bad day. So when you started looking and started evaluating your long-term retirement, your long-term retirement strategy, and kind of looking for these things, what markets, or did you just like immediately go in and say, oh, hey, I think this is the best fit for me? And if so, what markets did you kind of start like researching, or how did that look?
Yeah, good question. So to be totally honest, I had a bit of an unfair advantage. And I say that because I had lifelong friends in my family who had actually been investing in real estate and syndicating for a couple of decades at that point, maybe 1 to 2 decades. And I mean, I grew up like blocks away from them. I used to play I used to play hockey with their kids all the time, like, after school. So it was that type of a very long-standing relationship in terms of trust and knowing them. And so when I started to go down this path, the first thing I did, I said, okay, I'm going to try dabbling in a couple of their deals, because it wasn't just about I could trust them. It was also like, I'm going to learn a lot from them, right? And actually more than probably learn from an avid person, because I'm going to be able to get more of their time because I know them very well, et cetera. So it was definitely a lucky situation. Now that by default, and it's funny because I can't remember my first deal. I'll have to ask them. I get asked that question. I don't know the answer, but it was likely either in retail, office, I was going to say, or industrial, because that's the three asset classes that company focused on, but it was more likely on retail, strip center, or office, probably smaller office building.
Gotcha. And what now, just for context as to where we're at in the timeline, what year around was the first one?
Yeah, so this is early 2002.
Okay.
And the market, as you asked, so I'm from Montreal, Canada, and I grew up half my life there, spent half my life here so far in the US. At that point, I had just left the Canada only a few years ago. And so I left in 98, and that was 2002. So I didn't have very many contacts in the US. I didn't know who to trust. I also didn't know the markets very well, honestly. I'm new to this country at that point. So I was investing in a couple of deals in Canada at that time, in fact, out of the US. And that's a whole other ball of wax. So then you got like foreign exchange risk and all kinds of other stuff, right? But it was definitely not a US market that I started focusing on here.
Sure. And then so you had an unfair advantage, and now you also, I guess you call it real estate syndicating as in today's terms, but was it called real estate syndicating back then?
It just wasn't nearly as popular and understood and widespread, for many reasons, including, not the least of which is, now you can do a public solicitation of a 506c structure that allows you to actually market openly to accredited investors, for example.
Yeah.
So that was none of that back then. I mean, this is just a very recent phenomenon. I think that passed in 2015, if I remember correctly. So yeah, it was a very different time back then. I call it pre-internet. It was really just the beginning of the internet, really. Very difficult for me to find opportunities compared to today. No conferences that exist today, no podcasts that exist today, no online forums today, truly. And I was really lucky too, because another piece of luck that I had is I was actually in Los Angeles, a big city. And what that meant is that I was able to go to in-person meetings to network and learn and find these types of opportunities. And I did a lot of that, right? But had I not been in LA, it would have been much harder for me to ramp up my education, because there's not all the access you have today to all these nationwide, options. Very different time back then.
Sure. Oh yeah. And of course, I guess it would have just been probably referred to as just business, I guess, back then. I mean, it's just typical. And really, when you look at it now, aside of taking in private money or private equity or however you want to term that, but when you're looking at it from just a business structure standpoint, I guess a lot of these structures are pretty much the way they've been structured for forever. I mean, as far as the capital stacks and so on and so forth goes. So you've definitely been around for a while, and I'm sure you've invested in probably everything from, I'm assuming, multifamily and such as that as well.
I have been in most asset classes. The one that comes to mind that I haven't been in is hotels specifically. I'll give you a very quick list to give you an idea. Apartments, student housing apartments, mobile home park, self-storage, RV park, industrial, retail, strip center, retail, large mall, office. Now that's on one side. I've done single family buy and hold, single family flip, hard money lending on the and some notes on the single family side. And I've done stuff outside of real estate. So at this point, because I do this full time, I've been doing it for so long. I'm in over 60 LLCs right now. I've probably been in over 150 to 200 over time. So I'm kind of like hyper diversified, not to the point that I'd recommend people do that at all. It's just a lot. But I've been in many, many things. I'm currently in many things.
And do you pretty much the 60 LLCs that you're personally in, how does the management of that look?
But it's not as bad as it sounds. Although I will say we're currently recording this right around tax time, and I can tell you, like, the deadline for tax had just passed. I think I only got 39 of the K1s so far. So, only about 2/3, right? So now I'm going to have to wait for those to come. The last one normally comes in around August, depending, July, August. So there's that issue, but in terms of extending taxes. But the management of it isn't so bad because most of them will have a quarterly report and a quarterly cash flow payment. All the tax forms are created by somebody else for me. My accountant has to dealing with all these forms, but I don't have to put any together myself. I just have to forward them on. Given that I'm a cash flow investor, my number one concern and focus is on cash flow. And of course, there's 1,000 ways to invest. None of them are wrong. And whatever is best for the person listening is best that makes, but I focus on cash flow. So what I do is as soon as I go into an opportunity, I will take a spreadsheet that I have in Excel. It's very basic. It goes out by month over 10 years. And I will say, okay, this deal is supposed to project 8% cash flow year one. I'll divide it by 4 to quarterly payments. I'll actually put the amount that I'm expected to get and when they typically will make their payments, which month, and I'll put it into the spreadsheet all the way out. And then when it comes to the quarterly timing, I'll basically just check one off after the other when I receive them, make sure they look right. If it's with plus or minus, I would call it 15 to 20%. Then I don't really say anything. These are projections. I'm not expecting them to be perfect. That's just unrealistic. If something's way off, either on the downside or on the upside, I'll inquire as to why. And actually, the downside is a bigger concern. But frankly, if something's up to the upside, I want to understand what's going on, why things going so well. Like there's many different reasons. Is it temporary? Is it permanent? That type of thing. So that's how I manage it. To be honest, it's not that much management once you're in them. What becomes really tricky, though, is after a long time, once you're in this for many years and things start to roll over, if you want to keep your money working, you have to reinvest it and compound it. And when you have this many balls up in the air at the same time, I constantly have stuff either selling, reinvesting, looking at new opportunities. So there's constantly, like, if you picture me like a juggler, right? If a normal person is maybe in 10 to 20 opportunities down the line and I'm in 60, I've got a lot more balls up in the air at once. And that actually makes things more difficult. But my biggest concern is both making sure I'm getting all the payments I'm supposed to get, making sure they look right or about right, but then reinvesting the money and, getting ready and knowing, okay, well, I'm going to have 4 things exit in the next 3 months. I have a separate spreadsheet for this. And what is it, like, how many deals are coming up that I'm aware of? How much should I put into each one based on that money coming out, plus how much money I have in cash? I'm constantly trying to reevaluate what chunk of money is supposed to get into the next thing and where is that going to be and when is it going to be? So it is kind of a never-ending, ongoing equation.
Sure. And then I'm sure it's all the time. If you've got 4 deals exiting 2 months from now, having at least something on the radar that you can move that money into to keep that money working so that it doesn't just come in and just sit.
Yes, although I will say that I do not at all say to myself, okay, how many deals are going to exit in next year? This is how many things I have to go into. I don't approach it like that at all. I'd rather just go into deals that I find that I like and then figure out, okay, it's actually the reverse. It's like, okay, I have 3 deals coming up in the next 4 months that I have to fund. How do I fund them? How much should I fund into each one? Right? Then I have to go look at what's coming out. When's it coming up? How certain is it this one's really going to close? If I were to put a little more money in up front and wait for that one to cash out a week later, is that money really coming? Those are the types of things. But I'm not trying to. The one challenge in this space as an investor is that you never know what's coming up, and you also don't want to just go into a deal because it's there. You want to go into it because it's the right fit. So I'd rather have money sitting in cash than just making it go back into work just for the sake of making it work, Sure. And that's also because I'm pretty low risk. So that's kind of the way that I handle it.
You possibly, then you start getting into the risk of not having the cash when the good opportunity does come. So a lot of times, what we hear all the time is how do I get started? And of course we went through your story of where you found, how you kind of decided that this was what you want to do. But, for the guy out there that's sitting there that maybe has $50,000 or $100,000 and is just, or even in an IRA or a 401k or something like that, what do you recommend somebody like that do to just, I mean, it's so overwhelming because the amount of information that's out there and the number of opportunities that, like you said, for the sake of just jumping in an opportunity, what do you suggest somebody do just to even get the ball rolling?
Absolutely. So if I had to start again from scratch and I didn't have any of my prior knowledge, this is probably what I would do. I would say, okay, which asset class can I relate to the best? Is what's going to be the easiest one for me to learn right up front? And so I tell people, look, if you lived in a mobile home park and that's where you grew up, you're going to understand that asset class better than most of the others. Let's start with the mobile home park because you're going to be able to pick up the details of that much more quickly, right?
Sure.
A lot of people tend to like to start with apartments, and I think there's two reasons for that. Number one is a lot of people who lived in apartments can understand the business model. It's actually relatively easy and straightforward, maybe compared to some other asset classes, and that's number one. But number two, the interesting thing about apartments is that there's a lot of apartment deals out there. It's like if you think about a big city like where I am in LA. Think about how many apartment buildings there are for every one self-storage facility. Many, right? I don't know what the ratio is, but it's many. So that means that theoretically, you're going to have a much easier time finding an apartment opportunity, or at least finding a lot of them to evaluate compared to a self-storage deal, as an example. I'm not trying to pick on self-storage, just making a point here. So, so I would look at the asset class that I'm going to be able to understand easiest, start to analyze that, start to learn. There's a lot of ways to learn these days. You can listen to great podcasts like this. You can look for some online courses. You can go either virtual or in person, depending on your city. Panels, speakers you can listen to. There's conferences you can go to that are either focused on one asset class or many asset classes that you can particularly choose. And there's other stuff I'm missing too. So there's just a whole list of stuff you could do to start learning. One of the things I like to recommend, it's how I learned, and now it's not necessarily the most efficient way, but it's much more efficient than it used to be, is I like the idea of what I call opportunity exposure to learn, meaning that let's say you choose it's an apartment building, and let's assume you're a credit investor. You can now log on to, in your pajamas, the top 10 crowdfunding sites. Each one's probably going to have several apartment deals, as an example. You can download 20 apartment deals in the next 2 hours, literally, and then put them all side by side, look at the similarities, look at the differences, what are the preferred returns, what are the splits, what are the management fees? And you actually, imagine if you're comparing management fee structures on 20 deals, how much you're going to learn from that? Because you're actually going to be able to tell what the outliers are up and down and what I call market rate is. And just that alone will now get you to hone in on what am I looking for, what's fair, what isn't fair, right? So I did a lot of opportunity exposure myself because of the lack of educational tools that existed. And that is more efficient than it used to be for sure, because what I had to do to actually find 20 opportunities was a whole different problem than what someone has to do today. So, there's a lot of different options to learn, but I definitely recommend someone focus on one asset class that might be easiest for them, learn it all. And the cool thing about this is that you could probably transfer about 80% of your knowledge from one asset class to a brand new one. It's all transferable. There's revenues, there's expenses, there's net operating income, there's cash flow to look at, there's all kinds of stuff. From one deal to the other, it's identical. You have to look at different tweaks, right? So mobile home parks have a different consideration set a little bit than an apartment building, but some similarities for sure. So I tell people you could transfer about 80% of your knowledge onto different asset classes after, but I'd say focus on one, learn it, try a few different deals of that asset class. And when you're ready then to diversify out of the asset class, go for it. But that's what I'd recommend.
What's your favorite asset class?
Well, there's different ways you can look at it, I guess. So what I will say is that
obviously that may have shifted over time too. It's
right. Well, if you look at my goal is more predictable cash flow and a more stabilized deal. Being a value add deal is completely optional to me. It doesn't have to be like that because I'm just looking for more predictable cash flow because I live off the cash flow. I want that predictability. And that's why I got away from the predictability of the stock market. So to me, one of the most predictable asset classes someone can choose, assuming it's a highly occupied, stabilized, well-managed property, is mobile home parks. That has much lower turnover than any other asset class I could think, short of you like having a 20-year lease on a Starbucks, but then you have a single one-tenant problem. The challenge is no diversification. So I really like mobile home parks for that reason. But my top 4 favorite asset classes for the next 10 years, just based off of demographic trends, other things, would be mobile home parks, self-storage, apartments, and senior housing or senior living.
Wow.
Those four, if you're looking for more predictable cash flow with some probably reasonable expectation of continued future demand, that's less uncertain or more certain. Those are my four favorites as a generalization for the next 10 years.
Do you like the senior living space? That's one thing. That's one question that it seems like it always comes up. And of course, there's the idea of owning the real estate that the senior living facility is in. And then there's the idea of managing the senior living facility. And of course, the fact that those are almost two completely separate, I don't even know that you would want to be an investor in the management company of the senior living, but the real estate what's your take on that?
Yeah. So actually, I want to bring up a really important point before we even get to that, which is that these four asset classes I just mentioned, I should have given everybody the caveat that these are my favorite for the next 10 years, but I don't necessarily think that they're necessarily a great fit for me today. Sure. What I mean by that is the current market timing, right? So we're recording this in April of 2022. Interest rates are spiking up. Quantitative tightening is coming up. I'm mostly on the sidelines, right? Yep. I think on the 10-year horizon, they're going to be the best asset class for me, but maybe not today. So the reason why I go back to that comment about senior housing specifically is because senior housing has had greatly affected by COVID. And in my opinion, I think it has a very bright future in the long term. But at this exact timing today, I'm on the sidelines with it, waiting for the COVID challenges to shake out and some of the turnover to take place as far as ownership. Unfortunately, and I'm in a few deals right now, and unfortunately, some of these senior living deals got hit by COVID. And what happened is that once some tenants left because they were scared, it was very hard to get new tenants in during the peak of COVID, as you can imagine, right?
Oh, yeah.
People want to keep their parents at home rather than put them out into another world with a whole bunch of other people in one building.
Not to mention a world where they couldn't just freely go see them and talk to them.
Exactly. So I think that's going to be behind us in the next year or two. And I think we're going to be back into a more predictable path with senior housing, but I am concerned about that for now. And I just want to point that out. Yeah. So I'm sorry. Now I got distracted because what was the question again? I'm sorry.
The question was about the senior living real estate ownership versus the senior living actual management of the business itself.
Right. So look, senior living has many different verticals, right? So, and it's very complicated to really thoroughly understand. So you can go all the way down the chain to like what I call 55 plus retirement communities, which is literally just an apartment building that is restricted to 55 plus age group as tenancy. There could literally be nothing else to it as far as amenities or whatnot, but if you're over 55, you can live here. If you're under 55, you can't, right? And that is actually just like managing an apartment building, literally. Then you can go to kind of independent living, assisted living, memory care, nursing facility, and some other stuff. So senior living is very complicated to break down because it has its own verticals, which is unusual. Most of these other asset classes we've been talking about don't have them. So, and to your point, there's then a management company, and that could be either in-house or it could be hired third party, right? Just like any other asset class. Sure. And to your point, when you have a senior living facility, regardless of almost which verticals he's in, except for maybe the 55 plus, it's almost like a business. There's tasks. So someone once said to me, think about a senior living facility with 50 beds, right? Which is not uncommon. If you're in a assisted living facility, what's very common is that every morning, each one of these residents is going to have a newspaper at their front door, right? Or at the door of their unit. And that is 50 tasks for someone to fulfill. Right? 50 tasks, Jim's door here, John's door there. And then think about what is required every day to see all the tasks every day to senior live versus having a 200 unit apartment building for the random day that there's no repair, right? Because if there isn't a tenant problem, this isn't clogged or whatever. There are days where there may be 0 tasks is wrong, but maybe it's just a common area task as opposed to a client specific task, right? Yep. So the management of senior living is much more complicated. As a result, the cap rates have been historically higher. The risk is higher. The reward is higher, right? And then you have different levels of risk within all those different verticals I just mentioned, meaning that if you invest in a skilled nursing facility, that is much more difficult to manage than a 55 plus. The returns are going to be, theoretically, should be higher in the skilled nursing facility because the risk is higher, for example.
Sure. And then you got on the management side, you have the personnel management. Then you got to potentially have somebody to collect insurance, and then you've got to potentially have somebody to file government government insurance claims, which I
Yes.
think those are completely separate as well. But nevertheless, I mean, so that vertical, you're right, or that asset class, you're right, is very, but you can almost diversify within just that one asset class. I mean,
Yes.
for all intents and purposes, you could be in the real estate in part of it, and you could be in the ownership on another part of it, whatever the case is. But so you said, let's go back. You multifamily, mobile home parks. What am I trying to say?
Yeah.
Senior living and self storage.
That's correct. Those are for me, like, these, by the way, have to be in the right locations with the right management company, et cetera. But all those boxes checked off. Those are my 4 favorites for the next decade, assuming you're looking for more lower risk, more predictable cash flow.
Sure. And it seems to me like with all the cash in the market that came through and stimulus and so on and so forth, that the amount of stuff that Americans have accumulated, and I mean, just stuff, Amazon packages and whatever other kind of packages that they've gotten at their door, they have to have somewhere to store it, because Lord knows we don't throw it away. Nobody throws anything away, right? And so in theory, that's right. And then, one asset class that you didn't mention in your next 10 years that I want to just touch briefly on, is raw land, and could even be as much as farmland. Have you done any studying or thinking on any of just land type asset class?
Yeah, great question. So raw land is the wrong fit for me, only because it doesn't produce cash flow. And I live off the cash flow. So when I redeploy money, I want to make sure it's going to be cash flowing. I look for more predictable cash flow because I live off the cash flow. So that's my number one goal. Could be the perfect fit for someone else for sure. Farmland is interesting because it produces cash flow. But the challenge with farmland is that it doesn't produce predictable cash flow. And that would be my argument, because of weather, because of crop yields, because of other weather and crop yields around the globe, never mind the country, that can impact the price that you're going to get for a certain type of commodity. So I have always stayed away from that type of opportunity because the predictability of cash flow just isn't there compared to me investing in a 100% occupied mobile home park, for example.
Sure. And that's what, and I assumed that we were going to get something along those lines, because I didn't know you to be a land guy, but I just wanted to, I knew you probably had a take on it, and I had to see what I could get for it. So
Sure.
I thought that's a very good answer. And you're pretty much exactly right. There's a lot of risk for some reward, but depending on the purchase price, again, not great. But so, you talked about somebody getting in and possibly investing in the type of asset class that maybe, like you said, they grew up in an apartment building or grew up in a mobile home park or whatever the case is. So they obviously know the ins and outs and saw managers around and doing this and that. But when you talking, when we talk mobile home parks, again, now that's similar. I'm going to have a similar question about mobile home parks like I did senior living. Are you interested in mobile home parks that actually, like, you're not interested in the ones that own the park and the home, or are you talking about just the park and they rent the space to somebody that owns the home?
Yeah, great question. So again, I'm going to generalize, but typically there's 2 different types of mobile home parks you can invest in. You can invest in a majority owner-occupied home park, which means that most of the residents own their homes. Yep. And you are getting land rent for most of the residents, with the odd park-owned home sprinkled in, where the park owns the home and the land. Then you can do the opposite, which is you can have mostly park-owned homes, which is basically rentals typically, right? Yep. And that could be a majority large rental property. Now, let's see. First of all, I will say I've always focused on parks that have been at absolute maximum of 30% park-owned homes. The lower the better. As far as, in fact, 0 would be great too. That's not real. Almost every park I've ever seen has at least one park-owned home. Not all of them, but most of them. And it's very common to have 5 or 10% or 15% park-owned homes, or maybe even a little higher, depending on the situation. I tend to stay away from park-owned homes, any properties that are over 30% park-owned homes, because those are more rental type of communities. And while they do tend to have higher returns, they are more difficult to manage. They could have more problems. There's less predictability. There's more volatility. There might be more turnover. There might be more other challenges like crime, et cetera. It's a different type of park. So again, it's probably a good fit for the right person because the returns are higher. I think the risk is higher and the predictability is lower, and it's just not what I focus on. So I've always looked at the lower percentage park-owned home parks.
Sure. And I've seen firsthand exactly what you're speaking of there. I mean, the crime and the so on and so forth. And like you said, if you're going to have a park that has 80% park owned homes, you might as well have a 100-unit apartment building somewhere. I mean, it's virtually the same business model, but with a little bit different, maybe like you said, they're just a different kind of management take on that. So, well, what other investment advice, just general real estate syndication advice would you give to somebody who is looking at vetting sponsors and looking at saying, hey, why, this guy may not have quite the preferred return that this guy has, but I like these styles that he has, or something like that. Like if you were to step into a new deal and you had 3 managers and you had to pick one, what would be the qualities? I guess that's probably the better way to ask that question. What would be the qualities of a good operator when you start vetting somebody that you look at? Sure.
So first thing I just want to point out is that, in my opinion, who the manager is actually even more important than the property itself, and the property being a close second. Clearly, the property and the asset you're investing is very important. But I think who's managing it is even more important, because I think they have a huge impact on what direction that property is going to head in and how it's going to perform. And so, very good question. What I would say is I look for someone who's experienced, and so everyone's going to have their own opinion about that. But, I like to see someone who's done at least 7 deals. I don't know even how I came up with that number at some point, just to be comfortable, just random. But, and so if it's someone brand new, I'm going to kind of watch them. But I like them to learn off someone else's money. And I'm sorry that sounds the way it does, but it's just an honest answer, just in terms of risk reward. Number 2 is I'm going to look for someone who is conservative. So to me, I'm conservative. I'm looking for someone who is trying to underpromise and overdeliver to build long-term relations with those investors who want investors repeatedly investing with them. I'm trying to avoid someone who's overpromising and may underdeliver as a result. That could be just because they're using aggressive numbers, or it could be they're purposely using aggressive numbers and marketing because they're just trying to attract investors, and they're just going to go on to the next investor when I don't reinvest with them again, but they don't care because they're a marketing machine, right? So I'm trying to avoid that type of mentality. I've always found that the ones that I tend to work best with are the ones who are very similar on the same page with me. So when they're making assumptions, whether it's inflation assumptions, cost assumption, whatever it is, exit price assumptions, the one that's more aligned with my more conservative thinking is the one that's going to be the better fit for me. And so I'm trying to find a combination of an experienced sponsor who's also very conservative. And if I had to just think of the top 2, things I'm looking for, that would be it.
Good. And I'll tell you one that we look at, and I've always been a big, and as my listeners have heard me harp on this time and time again, I've always been a big quality of life person at the actual asset. Like, you can tell so much by just, even if there's a management company between the manager and the tenant, there's just things about a culture that pass through. And, if you've got a manager that's telling people, hey, we really need to cut our expenses, and those expenses are fixing dishwashers and making it a habitable, reasonable, decent place to live, then that's, you definitely have to look at there, because in my opinion, they're not taking care of an asset that you're invested with them in, if that's the case. Because, multifamily, and again, we always go back to 07, 8, 9, in that era where, I can't even tell you how many apartment buildings around the country, when we would travel and look and see and do that, there was, big signs hanging over the side wall that said free plasma screen TV with a sign of a 1-year lease. And, and you start getting, if you ever get into situations like that, and your manager, you don't have a tip-top manager that knows how to maybe even adjust rents. And of course, that's another big one that's potentially going to come 5, 6, 7, 10 years, 12 years, 15 years down the road, when, rents actually don't go up one time. You start having to manage them and bring them back in. So, what, geographically speaking, do you have any real specifics that you like to look for? Like, hey, I won't invest. I mean, I know what mine are, but I assume you probably do. But do you have areas where you're just like, I'm out. I don't want anything to do with those?
Yeah, great question. So I would say that as an overall kind of philosophy, I'm much more of this market doesn't work because of X, as opposed to like I'm only looking for these markets. So to me, it's an exercise of exclusion instead of inclusion. And so I'll stay away from markets that are very volatile and expensive. So Los Angeles, San Francisco, New York, Miami, great markets for the right people. Wrong markets for me. Not only are they not cash flowing as much as the next market, but the prices tend to go up and down a lot. And so I'm looking for more predictability. I'm trying to stay away from those volatile markets. I'm also typically going to stay away from hot markets for the same reason. So great example for those of you who can relate, Denver and Seattle, great cities. I've been there, both of them, many times in the past few years. What I would say is that they became very hot between, let's say, 17 and 20 of pre-pandemic. I was staying away from them because at that point, the prices were just too high and the cash flow wasn't there for me. And I'm not trying to chase a hot deal. I'm trying to do the exact opposite. I'm trying to go into a value play. So that's number two. Number three is I will stay away from a market that is very low income. And frankly, I normally stay away from a market that's very high income too. I'm just trying to go into the mid-range and looking for more predictability, more of what I call an A- or B market, and a B type of asset class. And again, I'm just kind of, no one's probably surprised, but I'm just looking for predictability. I'm looking to be midstream, and I tend to invest outside of California for a lot of those reasons that I mentioned, even though I live here. But I'm open to what I've learned about the U.S. and it's interesting because I had a interesting perspective because I moved here in '98, right? Yeah. And having not grown up here, I was open to anything that made sense, and I still am today, right? And it's blown me away once you go, like I've been in over 43 states just for business looking at deals, and it blows me away how many different markets are good in the US, right? If you're going to be open-minded, right? If you come from the East Coast, Northeast, and you say, I only want to be in New York and Vermont and Connecticut, maybe that's okay because you actually know those markets better than all the other markets. But man, there's great markets all over the country, right? That you could consider. So I tend to be much more trying to exclude the markets that don't make sense for me, as opposed to try to figure out the few that I just want to include.
Gotcha. Well, and that's, and I think that's true for just about anybody. And of course, with you being in LA, it's a little, not passing on something that could be potentially at your back door is something that I think those of us that are in more tertiary markets or markets that are not necessarily just, it's like if something came up 10 miles down the road, you better believe we'd be all over it or trying to be all over it anyway, if it made sense. But, that's so that's a little different take on some other answers that I've gotten to that question. But
yeah, I do want to clarify one thing though. I tend to stay away from tertiary markets myself only because they tend to be more volatile. So they tend to be, have more price variation than what I call secondary market. So when I said a B market, I meant a secondary market. That's what I tend to look at. Just FYI, and again, there's no right or wrong answer for this. It's whatever is best for the fit for the person and what their goals are, because there's 1,000 ways to invest. So
sure. And is there any other particulars that you look? This is the question I was kind of going to try to get to a minute ago, and I've reformulated it in my mind. But is there any other, like, maybe, for instance, you made a mention, I think it was you want to invest with somebody that has done 7 deals. Now again, you made mention that I have no idea where I came with that number. Want to do 7 deals, but is there any other just kind of, because obviously there's something in your mind somewhere that maybe you invested one time with a guy that did 6 and it went not so great, and you invested with a guy that did 8 and it went great, and then all of a sudden you're like, okay, hey, the average of that, we'll leave it at 7. So is there any other little, like, nuance ideas or nuanced thoughts that maybe you give things that may just be something that like that may not just stick out to everybody else?
Yeah, well, so just to clarify the 7, if I say to you, how many, I don't know if you have kids, but I have kids. How many Hershey's Kisses is too many for one sitting? And you and I debate, well, is it 3? Is it 6? Is it 4? And I guess what we're both doing is taking this notion in our mind, which is what sounds like too many or too few, right? Sure. So that's really how I came up with that more than anything, right? But I will say this, I am willing to give weight and credit to someone, because look, there are people who've been in real estate for 10 or 15 years who then go syndicate on their own. They've actually either worked for other companies who've done it. or tangentially, they kind of worked their way up. They started as a realtor, then they did this, then they did that. They did commercial leasing, and you add up all this experience, and it could be significantly better than someone who's done 7 deals straight out of college, or just someone who just, literally was a tech programmer and then they just started this. And there's nothing wrong with any of that. But
yeah,
so I tend to add some weight for sure on someone who's done stuff in someone else's company, depending what it is. And they may not take me 7 deals for that person, right? Yeah. So we can get into the nuances, but then that person, do they have experience managing investors? What does that mean to them? Do they have no clue about that, which is possible? What does that mean? There's a lot of things to look at. So I didn't want you to think it was like a hard line. That's the easy answer that I can give.
Gotcha. And that seems to kind of bring the average of everything together at some point, and maybe you add some for one deal or something like that. Makes perfect sense. And I mean, and that's the thing that's so many times when we start talking about the people looking and vetting new sponsors and looking for people to make investments with. And it's like, man, listen, I can't tell you to feel comfortable with that guy. I can't tell you that maybe you feel comfortable with him. Maybe I'm like, he's just, like you said, too much marketing fluff or too much this or too much that. But maybe this guy goes in and he connects to him on a completely different level. They're both into weightlifting, or they're both into cars, or they're both into motorcycles, and they connect on that level, a level that I didn't necessarily connect with. And so, I guess that question is could be a little bit loaded too, in saying that, hey, what do you look for? But because there's going to be things and people you connect with on a different level than I do. So, well, listen, Jeremy, we're kind of pushing up here against time. I don't want to keep you any longer. I know that you're a busy man. And again, like I said, anybody that mentors my mentor, I'm definitely going to listen to, and definitely going to be all ears when they start talking. And you were one of those guys. So I can't thank you enough for being on here with us today. And I know the listeners, if they picked up just any one little tidbit, maybe one of them's going to put down and start making sure that their next sponsor has done exactly 7 deals, So I just, but I can't thank you enough.
Oh, absolutely. No, thanks for having me on. I just hope the episode was helpful for your listeners. So thanks again.
Sure, absolutely. Jeremy, thanks again. And that's Jeremy Roll. And that's, I want to make sure I get it right, Roll Investment Group. And real quick, Jeremy, if somebody wanted to reach out, maybe had a question about something we covered, is there a way for them to do that? Do you have a website or an email or anything like that?
Yeah. So
I guess we gave you your website, but.
Yeah, no website. I'm just very much under the radar, focusing on investing. But I will say that anyone is absolutely welcome to reach out to me through email. If you're brand new and just have some questions that I can help. If you're experienced and want to network as an experienced investor, a sponsor, other investor group, I'm happy to network with anybody, frankly, or help any way I can. My email is the best way. So it's jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com.
Awesome. Jeremy, thanks again, sir. And I hope everybody has a wonderful day. And thank you for listening to the Cashflow Pro podcast. Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.